So of our financial KPIs, what we look at, right? It's net worth and cash flow and total tax liability. And total tax liability really impacts net worth and cash flow, right? Because the game of taxes is really a game of saying, how much money can I save on tax? But what if saving all of your money on tax meant that all of it got pushed into net worth types of investments that only paid you out in 30 years? So, well, I saved on tax, but did I really do this thing that I wanted to do called having enough cash flow to make sure that I can always have gas to put in the car? Like I saved on tax, but I lost on something else. Yeah. So this is why we look at different types of investments, and different types of investments offer different types of cash flow, different types of net worth plays, and also different types of tax benefits that go along with them. So I would like to offer you the idea that this is what you're a CPA, MBA, CFO type mind is supposed to be structuring for you if this is not something that you typically do for yourself. Because the game is this. You look at your top line revenue, right? Because we're a company, right? So we're going to look at our top line revenue. And then what we're going to do is say, well, what are all the deductions that I can take, right? How can I make that trip to Hawaii that I went on to a business expense by scheduling some time with some real estate agents? Like while we're out there and I looked at some properties. Now, can I write that whole thing off? All right, perfect. Now I got a business expense. All right. And what are these expenses can I have? Can I put my cars into the business? All right. What about my home office deduction? All right. Can I pay my kids maybe a reasonable salary, maybe 15K a year to be able to do some work on the business and create some additional deductions there and shelter some money underneath the lowered tax bracket? So, and after you're able to creatively and legally use all the deductions that you want, your next big move is all of your tax shelters, right? Those are some of the things that I showed you in the previous slide. That's your self-directed IRAs, your solo 401ks, your defined benefit plans, and your private foundations, and some other vehicles. Augusta rule, another one of those things that you can do if you have rental property. And then after you look at the types of shelters that might be appropriate for you, the next thing is actually looking at the type of investing that you're doing. Because the type of investments that you make are the ways in which you're able to reduce your tax liability down to zero, while also balancing what are some of the things that you can do with your cash flow and your net worth. So before we jump into the tax shelter side of things, let's all really understand that there's just a few different types of investments, really, that can fit into some buckets pretty neatly. You typically have your high cash flow types of investments. This is something typically like your notes. If you're doing, algorithmic types of Forex trading, which is one of my favorite current strategies that I'm doing for the cash flow part of my portfolio. Those are going to be your big cash flow plays. Then you're going to have investments that are, and I'm not recommend anybody do these, especially given the IRS scrutiny right now, but just for the point of being able to give an example, but for your conservation easement types of investments. These investments were like, hey, if you give us 100K, then what we'll go ahead and do is we'll give you $500,000 in depreciation. It's just a pure depreciation play. It's a pure tax play as a type of investment. There are pure net worth investments. Those would be just investments that says, hey, you give me this much money now. 5 years from now, I'll give you back double or triple the amount of money that you gave me. But in the meantime, I'm not going to give you any cash flow. And then there's your self-storage types investments. Right now, I really like the deals Patriot Holdings, for example, offers. You can find that on their website, patriotholdings.com. And those typically have a blend. It's typically like a 9% pref rate on your cash flow, 20% to 25% on your net worth appreciation that exits. You get paid out on that when the deal exits in 5 years, but they'll give you 150 to 180% bonus depreciation. So this is this blend of net worth and cash flow and depreciation. Now, what's going to be appropriate for you? Totally depends on your knowledgeability of those types of assets. How comfortable do you feel with those types of deals, with those different types of operators? You may never heard of algorithmic Forex trading before. So you'd say, great, Scott, I don't even care if it pays a 36% return, doing that kind of stuff. That sounds like something crazy. That sounds like something kids are doing these days with AI bots and whatever. I don't know anything about that. Well, great. Those aren't places to put money. But the point that I'm trying to make at this time is just to know that there's these different buckets of assets, right? And just like there's these different buckets of assets that differently impact our cash flow, our net worth, and our total tax liability, and that we want to strategize to say, well, what is the cash flow that I need? What are the tax benefits that I need to get my taxes down to zero? And how well can I impact net worth, and do the math to be able to say exactly how much money do I need to go in each type of investment? You also have your tax shelters in place. So let's talk a little bit about tax shelters. So of the different types of tax shelters that you have, some of these are they will all help you save on tax. Some of these can help you save on tax differently, and some of these can help you save on tax while still being able to allow you to have liquidity if you need it. So when we look at our types of tax vehicles like self-directed IRAs, solo 401ks, and defined benefit plans, what we're really trying to do here is say we have a dollar threshold that we're trying to meet. I want to protect all of that money from tax. And at the same time, what I'm trying to do is to say, I'm not really worried about cash flow off of that. I'm not using those dollars to be able to accomplish a financial freedom objective or to otherwise be able to access any of that capital. I'm really using it as essentially as a long-term net worth play, a quasi type of insurance policy for my retirement. Nothing wrong with using retirement accounts. I find that typically retirement accounts are best used after you accomplish all of your cash flow objectives that you're going to need to be able to live the lifestyle that you want. And it really just turns into a place of the heck with it. I don't need more cash flow. What I really want is just to save the money on the tax and sock it away.